So I'm not the kind of agent that's going to yell, "Show me the money," through the phone like Tom Cruise did on Jerry Maguire. But I am the kind of agent that's going to show you all the options for you to be able to purchase commercial real estate. My name is Lexi Sims. I'm a commercial real estate advisor based out of Houston, Texas, and I help people purchase commercial real estate to build wealth. Let's get into it. And make sure you watch until the very end, because I'm going to be talking about the best kept secret when it comes to financing a commercial property. So stay tuned. Quick fun fact about me: I am actually an industrial engineer by degree. That's what I went to school for. That's what I did for 7 years. And then I realized that I really did not like what I was doing. Fast forward, now I'm into commercial real estate. But with that engineering background, it really gives me a foundation for making sure that I know all the variables in a situation. What are all the factors and how do they impact each other? And that has been so beneficial in how I see properties, how I see investments, and then how I advise other people as well. And when it comes to factors that affect your financing for a commercial real estate property, the main thing is going to be whether or not you occupy the property yourself as a business owner or an owner-operator, or you are a straight-up investor who does not own a business or run a business out of the property that you are purchasing. So if you are a business owner, that means that there are specific loan products and programs that are available to you because you are going to own the property as well as occupy it. And those loan programs typically come with a lesser down payment. So we're looking at maybe 10% down as opposed to 20 to 25% down. And I have a whole video on a specific loan property called the SBA 504 loan. I'll put a link here so that you guys can watch it if that happens to be your reality. Now, if you are not going to be an owner-operator, that is a whole different set of options that are available to you. And we're going to go through a few of them one by one and talk about some of the pros and cons of each. So make sure you stay tuned. So first up is going to be the conventional commercial loan. And that's one of the most common, but it can also be one of the most misunderstood because the structures can be a little bit confusing. So one of the structures that is common is going to be something that's called like a 525 or a 725, for example. And in that case, that's when the loan for the term for the loan is a certain amount, but the payments are amortized over a different amount of years. So let's say the loan itself is a 7-year loan, but the payments are amortized over a 25-year period. So that allows for a lower payment every month, and it leaves you at the end of that loan term with the bill still due. So that means you either sell it or you can refinance out into a different loan. And so things that are going to be important here are going to be that DSCR, the debt service coverage ratio, the loan to value or how much you are putting down, and then also the borrower profile. How well qualified are you to be able to finance a loan like this? And that's another reason why in this situation, relationships matter so much when it comes to banking and who you're going to choose to do your financing, because those relationships can really be a difference maker for you. So this next one is really a game changer and one that I feel like is completely underused in the financing space. So this one is called DSCR, or debt service coverage ratio. And basically what that means is that the property itself is able to pay the mortgage. So that means that the rent that you are collecting from your tenants is enough or is equal to or more than the mortgage amount. And that alone is what qualifies the property for the financing. So this loan is not based on borrower tax returns or even their income, which is a huge advantage to the borrower. It is solely based on the property's ability to be able to pay for itself. Now, don't get too excited here, because you do still need to be able to pay your down payment and be able to show a certain amount of cash reserves in the bank. But that is a huge advantage to people who might be a little iffy on taxes or their income, because it still allows you to be able to purchase property and use financing to be able to do it. Bridge loans can either be an expensive mistake or a legitimate tool, depending on what it is that you're trying to do and what your goals are. So bridge loans are used to do things that add value to a property, whether it's capital improvements, a rehab, or renovation. A bridge loan is going to allow you to purchase that property, do the work on it, stabilize it, and then refinance into a longer loan product. So a bridge loan is typically a shorter term, but it has higher rates. And so you want to make sure that you are able to refinance out of that into something that allows you to pay for the loan over a longer period of time. And you can think of a bridge loan as a gap between where the property is in its current condition and then wanting to get it to its final state. And so hence the bridge loan. seller financing is a lot more common than most people think. And I know I said DSCR was underrated, but this one is probably even more underrated because you are able to come up with your own terms as far as the length of the loan, the down payment, the rates on the loan, and the seller is the one actually carrying the note. And there's literally no bank involved in this from your standpoint. So it's a door that is open to most people, but that most don't even go in and ask about. And it especially works well in a market where rates are a little bit higher because you have the power to be able to negotiate something that works for you in that specific deal. So make sure you keep that seller financing option in your back pocket. So questions to ask your lender before you go signing any documents or submitting any applications. First is going to be, do you offer commercial loans? Because not everybody does. And if they don't offer commercial loans, that's not going to be something that is going to work for you. Next is going to be, what is the DSCR requirement? And that way we can run a few numbers and make sure it meets the requirements before we spend any time applying for a loan that won't even work for you. Also, what types of structures do you offer? So do they offer things like the 525 or 725? Do they offer bridge loans? So we need to know all of that up front. And then what do you need from me? Do I need certain credit requirements, certain capital requirements to qualify for some of your loan products? And having the answers to those questions will save you so much time. If you come to me and say, I have $200,000 and I'm looking to invest in commercial real estate, what route do you think that I should take? Now, my official answer is going to be that we should sit down, run all the numbers, get with the lender, apply, do all the things, ask all the questions to make sure that you're in the right position, and then from there determine which route is best for you. My unofficial answer is always the DSCR. I'm very partial to that one because I really appreciate how it is property specific and not necessarily based on the borrower's qualifications. All you really need is money to be able to pay it, and that's really it. So if you are serious about taking some next steps, finding out what might work for you, then you should book a one-on-one call with me. There's a link in the description to be able to do that. And what we would do is go over your goals, what it is that you're looking to do, go over your financing, what you are able to do, and then come up with a plan from there. So there's a link in the description to be able to do that. Make sure you like and subscribe and book the one-on-one, and I'll see you guys in the next video. I'm Lexi Sims, commercial real estate advisor in Houston, Texas.